Today we're going to talk about the 2 ways you can access money out of your IUL. My name is Amanda Ryba. I have been a licensed financial coach and consultant for the past 8 years, and it is my goal to illuminate to the world what wealthy people know and understand about money. And one thing all wealthy people know is how to leverage their money in 2 places at one time to earn interest. And I'm going to show you today how you can do this with an IUL. Now, if you are working in the industry, this is definitely a video you want to pay attention to because it's going to teach you some different features that you can share with your clients when talking about this product. And if you are a potential client, somebody that's been looking into IUL policies, but just not sure if this is something that makes sense for you because you fully don't understand how you can get your money out, this video is going to tell you everything you could want to know. Let's dive in. So there are 2 main ways you can access money out of your IUL. You can take money out in the form of a loan or a withdrawal. Now, I know they sound similar, but they're actually very different. So withdrawal, let's start here. A withdrawal actually means you're removing your money from your insurance's cash value. Think of it very similar to like when you're taking money out of your bank account, right? You're actually removing it from the account. But we're going to use the example of a stock portfolio. Let's say you go and try to take money out of your stock portfolio. You're actually withdrawing it out, right? You can do that. But what happens? You are going to pay taxes on any interest that you withdraw, right? You can always get to what you put in tax-free out of just a basic brokerage account, but your interest is going to be taxable. And it actually works the same way with an IUL. You can withdraw out your principal, your cost basis, what you contributed, but you can't withdraw your interest tax-free. Your interest is going to be taxable. So we kind of call this the dumb way to access money out of your IUL because of the fact you have another option where that's not the case. But unfortunately, people don't always know they have 2 options when it comes to pulling money out of their IUL. Another downside to withdrawals is you don't have the ability to put the money back in. So if you do not know, IULs actually have a cap on how much money you can contribute per month or per year into the account. And it's based on the size of the death benefit or the amount of insurance the client gets. The more life insurance you get, the more money you can put into the account per year. The less life insurance you get, the less money you can put into the account per year. More information located in the video, in the description below on this video, but you're going to be capped. So let's just say, for example, you have $150,000 in your cash value available for a loan, and you take out $100,000 of it. Now you're left with $50,000 inside your account. Well, how much of that was interest, right? You're going to pay taxes on whatever was interest. And let's say you're capped at 10 grand a year and you want to put the money back in. Well, you can't put in more than 10 grand a year because you're capped at 10 grand a year. So again, not the smartest way to access money out of your IUL. Compare that to a loan. And now I know this sounds crazy because I get this all the time from people. Why the heck would I want my money somewhere where the only way I can access it the smart way is in the form of a loan? That doesn't make sense. But friends, yes, it does. Let me explain to you why this is a huge blessing that we even have this as an option through an IUL. The only other way you can get access to do things like this is through things like marginal loans, and you have to be a very wealthy investor to have that feature. So loans, my friends, they allow you to get to your cost basis, which is what you put in, plus your interest, all tax-free. Why? Loans are not considered taxable income by the IRS. Let's talk about it, right? Let's say you went out there and you took a loan out to buy a car. Did the IRS tax you on that money that you took out to buy the car? No. Let's say you took out a loan to go buy a house. Did they tax you on the loan that you took out to go buy the house? No. Let's say you took out a loan to go pay for student loans, right? College. Did they tax you on it? No, because a loan is not considered taxable income. So this is actually very brilliant when you think about it, where the insurance company allows you to loan yourself your own money, which allows you to get to your interest and your cost basis, which is always tax-free, but all tax-free. And the best part about it is there's no repayment agreement. It's not like with your car or your mortgage or your student loans, you have to repay it by a certain date. That doesn't exist with these loans. There's no repayment agreement. If you die with an outstanding loan, the insurance company will just deduct whatever you owe from the remaining cash value. And then the rest goes to your beneficiaries, all tax-free along with the death benefit. It's genius. Now, it also gives you the ability to pay the money back into the policy. Remember how we talked about earlier, if you're capped on what you can put in per year, you can only contribute so much per year into the account? Well, same scenario, if we had 150,000 and we borrowed out 100,000 and your max that you can contribute per year into your IUL is only 10 grand a year, Well, because you took that $100,000 out in the form of a loan, you have the ability to contribute it back into your policy all at one time in small increments, however you choose to do it, in whatever way you choose to do it. Just be mindful if you are doing either one of these options, to be realistic, you also don't want to fully deplete the account because you're going to have to continue to contribute money in to keep these accounts open and active. You never want these accounts to close because they are permanent life insurance. If they close on you because there's not enough cash value in there to allow them to thrive and survive, all of your interest is going to be taxable regardless which way you go. So the key is the account has to stay open and active. But there are two ways that you can access money on the form of a loan. There's two ways. You can do declared or standard loans, or you can do alternative variable participating loans, right? 3 different words all mean the same thing. Every insurance company explains it differently. A declared or a standard loan is very similar to a withdrawal in terms of you're actually removing your money from the account. The only difference is it's on the form of a loan versus a withdrawal, which on the loan means you have the ability to pay it back. On the withdrawal means you do not, right? Tax-free, taxable. So if you're going to do a loan that you maybe don't ever plan to pay back, that's probably the loan type that I would do because usually the interest charged on it is next to nothing. Sometimes it actually is nothing. It's what we call a zero wash loan, which means you can actually borrow the money out 100% for free and you don't have to pay it back. Where in the world today can you go and get a loan from the bank and not be charged really any interest? It's crazy, right? But on the other hand, participating or variable or index loans, those work very differently. This is something very unique to insurance companies and permanent life insurance, where if you had that same $150,000 that we keep talking about and you want to access $100,000, the insurance company is going to look and see, okay, they have enough money, right? They have enough collateral for this loan. So what we will do is loan them our $100,000. We will allow them to keep their $100,000 inside their account growing and earning interest. And we will charge them a small nominal interest rate to borrow our money while still crediting them interest every single year inside their IUL. Now, that sounds like a mouthful. All it basically means is you have the ability to borrow the insurance company's money instead of your own. Your money gets used as collateral for the loan. They're going to charge you somewhere between 4.5% to 5.5% interest. Most of the time it's simple interest every single year until that loan is paid off. But most IULs are averaging over a 30-year span, somewhere between 8 to 9, somewhere even up to 10% interest on average per year over a 30-year period. So if you're earning, let's just say 8% one year, you're paying 5% to borrow it out. You are netting 3+ +% interest on money that really doesn't even exist inside your account. It's not even technically yours because you have borrowed it to go and finance a project or invest in a business or purchase some real estate. Now, these loan types, I'll be honest, I usually do recommend that you plan to pay them off at some point because they are charging you interest. And if you take that loan out in a year where the markets are down and you're not earning 5, 6, 7% interest, that means you actually really are paying real true interest on this. So you just want to be mindful of that. But it's a phenomenal feature that allows you to earn interest here inside your policy and go take the insurance company's money and go finance and build a business or invest in some real estate and earn interest in another way. And then you can use the profits from those transactions to pay off your loan. That, my friends, we call infinite banking, and that is only done through participating indexed or what we call variable loans. Now, not all insurance companies offer that bottom loan type. They don't. So I would really recommend, if you are looking into IUL policies, that you work with an insurance company that has both loan types. You want to know what the loan rates are. You want to know how early you can access the loans. Most insurance companies don't even allow you to access a loan for at least 1 to 2 years. I work with insurance companies that allow you to access a loan after 30 days. And that's really important because you just never know when you're going to need to get to your money. So hopefully this is helpful. Again, you've got these two options here, withdrawals and loans. Dumb way, smart way, right? Because of the ability to pay the money back, it's tax-free, and it's just more flexible overall. I hope this video gave you some really good coaching and guidance on how to design these policies and structure these policies and talk about the features to clients if you're new to the industry. And if you are a potential client looking into the industry, hopefully this video gave you some clarity on how flexible and easy it is to get to the money inside of your IUL policy. And one last little piece of advice here, if you are trying to do a loan or honestly a withdrawal, it really just takes 2 to 3 days to get the money back into your account. It's relatively pretty quick. It's not like you're waiting weeks and weeks and weeks to get the money. It's pretty fast. So that being said, if you are looking for more information on these accounts, or you're in the industry and you want to work with a coach that knows how to do this the right way, I have been in the industry for over 8 years. My team and I are well trained on these products. We've been using them for over 8 years, and we'd be happy to share with you more about how they work or coach you on how to properly structure these for your clients. All you have to do is click the link in my bio or in the description below to book a call with me or somebody on my team, and we would be happy to have that conversation with you to see how we can help you out. And if you like this video and you want to see more content just like it, you're welcome to click that subscribe button and hit the bell to turn on notifications, because I release a new video every single week. And I look forward to seeing you back here next week on YouTube. Share this with a friend, and we'll see you next week.